Interesting. Okay, I will. I'll check on that. Okay, and that's for the Fallbrook house, right? Over here. Okay, nice. Okay, sweet. Yeah, look forward to it.
Okay, it's recording.
All right. Okay. Cool. We'll talk then. Bye. So VA loan, would there be a problem? Appraiser said that for an FHA loan, if there's a utility pole on the property, that's in close distance to the house, could be a problem for FHA. Not a problem for VA either. No, I never heard anything like that.
But yeah, I've never done that.
Just doesn't know.
Yes.
Pooh from Shinola.
Pretty much. All right, guys. So I'm gonna start the modules here. So we're gonna skip the first one. It's more like an introduction.
Here's.
Sorry.
All right. So
is there a specific like fund or specific like ticker on the Wall Street like stock exchange that
you're gonna follow? Yes, it's gonna be
that they're shorting?
Yes. MBS group.
It's MBS group.
Let's say MBS coupons. We'll talk about more of that, but like right now, probably the 4.5% new MBS.
So that's Summit shorting them.
Summit shorting them. Yeah. But there's stuff skipping ahead.
Yeah, those are my questions too.
Yeah.
That's actually.
Let's watch this first. We're gonna throw off our timeline, and you guys know that Aileen is going to start telling us, kicking us out, and getting me back on my calendar if we wait too long. So let's start this first. This is the easiest one.
Let's talk about personal wealth creation and retirement, because after all, as a certified mortgage advisor, you're doing this to help others. You're doing this to change their life. But how about your own life? We want to make your life better as well. We want to make sure that you've taken care of your own retirement. You've created wealth for yourself, because you know what, then it just transcends. It transcends because what you're able to do is you're able to take that knowledge and take that firsthand experience and help your clients experience that as well. So I'm going to start off with a question for you. And here we go. The question is a really simple one. It's this. What would you rather have? Would you rather have $100,000 cash right now? Or how about instead, I said, listen, here's what I'm going to do. I'm going to give you a penny. But that penny is going to double every day for 1 month. What would you rather have? I'll help you out a little bit. So let's take a look at the first week. So, you know, a penny the first day is a penny. And then after that, the next day it's 2 cents, then 4 cents, 8 cents, 16 cents, 32 cents. And at the end of a week, you've got 64 cents. So, you know, would you rather maybe make sure you take that $100,000 in security? You think that 64 cents with just the rest of the month remaining would be better? Let's continue. So now you can see you go to $1.28, then $2.50, $5, $10, 20, 40, $82 at the end of 2 weeks. At the end of 2 weeks, that's still kind of far off from $100,000 in cash. So let's continue. The third week, you get all the way up to about $10,000 after 3 weeks, but still far off 100,000. Let's take a look at the fourth week, and now you can start to see 20,000, 40,000, 80,000, 167,000, 335, 671,000. Heck, at the end of 4 weeks, that 1 penny doubling, it's $1.3 million. But we still got a little left in the month, don't we? We have 2.6 million at the end of day 29, and at the end of day 30, $5.3 million. But you know what? What if that month had 31 days in it? Well, then you'd wind up with $10.7 million. That's just a penny doubling every day. So what's the secret here? It's the magic of compound interest. It's the magic of doubling. And it's the magic of how your wealth can grow over time. But the trick is, you've got to start early. See,
so just so you guys know, like the application here, when we do a professional home buyer presentation, we should be advising them as to why you should be investing your 401k, some other things, but which is why Cynthia has more money than all of you guys, because she's been maxing out a 401k since she was 18 years old. But yeah, how much you have in your 401k? Remember, it was like close to $500,000.
Don't worry, we're not your husband.
Close to $500,000. But the other important part of this is when people say, oh, look, I'm afraid that the home's going to lose value. I'm thinking I'm going to kids you save, I'm going to put that money in the stock market. There's a big difference between investing in the stock market and investing in real estate. I'll just show you something real quick, because I'm putting something together for everybody, but let's see it.
Do you have that graphic?
The one I just made like a minute ago. This
No.
one. So I just made this graphic. So if you got, are you guys able to see this? Ryan, give me a head nod. If you can. Give me a thumbs up, Ryan, if you can see this.
I don't think so.
Okay, let me give it.
That's-
That's a good.
That's can see it.
They should all be able to see
Do
it.
you see like, does it say leveraged investment there?
Oh, no.
No, okay. Let me see, stop share.
Don't leave Dustin.
Not looking.
I usually don't, believe Dustin.
He's asleep.
You used to have to share again, pick the right screen.
He's got the wrong glasses.
Sorry, I've been moving all day. A little tired.
Wah, wah, wah.
No excuses, buddy.
Yeah. Started getting ripped off.
You guys have to see this?
Yeah.
Okay, so I just put this together, so it looks a little rudimentary, then deal with it.
It looks good.
So leverage investment. So if I took $50,000 and put it into the stock market, let's say I had $50,000 available for a down payment, and I put that in the stock market. If I put that into a stock market, let's say it was earning 10% per year, which is a really good return. It's pretty close to the S&P 500's annual rate of return if you averaged it out since the 60s. But it's still a great return. You're at the end of that 10-year period, you would have gained an additional $85,000 value. So the compounded rate of return, so using a simple annualized rate of return on the investment would be 17%. Now, if you took that same $50,000 and you put it as a down payment on a $500,000 house, why does it turn to $323,000?
5% on 500,000.
Exactly. So so imagine if you put 50,000 into the stock market and they gave you credit for putting in 500,000. That's what you're doing when you buy a house. You're putting $50,000 down, but you're leveraging it into a $500,000 investment that's been down at, starting at 500,000. So this is the equivalent of you putting $500,000 in the stock market over the course of 10 years. So
But leveraging 50K.
you're leveraging 50K into 500. And you can even get more aggressive than that. You put 5% down. So your rate of return is something that will become important to discuss with your clients when you're talking about home ownership and the benefits of home ownership and why putting the money in the stock market because it's earning 10%, and not right now, it's losing money. But 10% in the stock market versus 5%. This is 5%. This is not a 10. This is a 5%. This is half of the rate of return.
Can we get a copy of that?
Yeah, it's one thing. No, I'm just kidding.
Yeah,
I made. Yeah, I'll
Put it on
find
quick
out.
tab.
I literally just made that
I'll let
a
you
couple minutes ago. So, all right, let's get back to it. I just wanted to show you guys a couple applications there.
Hey, Josh, could you email that to us?
Yeah, I'll email it to everybody on here.
Okay. Then I could throw it in a PowerPoint that I'm working on and stuff too.
Hold on. Yeah, and you can this should be added as a part of your can't record. It should be part of your professional home buyer, professional home buyer presentation, which I know we're going to start working on, Ryan. We're matching you guys up. All right, who knows how to use it better?
What are you trying to say?
I'm trying to share screen the MBS highway. Or this one. All right. Get back to this. Sorry, guys.
This is the chart I wanted.
Earliest you start, the more doubles you get. And as you can see, it's the last double that makes all the difference in the world. You want that last double. So this is a good exercise. Open our eyes up. The magic of compound interest. You know Albert Einstein? He said the eighth wonder of the world is compound interest. And I believe he's right. So when we take a look at this and we say, okay, how do we quickly know how long it would take to double? There's something you may have heard of, and it's called the rule of 72. So the rule of 72 simply says to divide 72 by the interest rate as a whole number, and that'll give you the number of years to double. So let me give you a quick example. If you took 72 divided by your rate of return, that equals your time for your investment to double. So here's some numbers. 72, and if you're able to get a 9% rate of
Sorry.
return, well, then your money would double every 8 years. So think about that. If you're able to get a 9% rate of return and you were to put
I'm trying to move the screen. but it
money
won't.
away at that, it doubles in 8 years and then it'll double again. So it'll be worth 4 times as much 8 years later and then double again. So it's 8 times as much 8 years after that. Again, the trick is to start early and you can gain enormous amounts of wealth. Most people don't start early. So that's why understanding these concepts as early as you can, and then more important than that, teaching these concepts will give you the benefit of being able to change people's lives. So let's have some fun here. Now you're working very hard. I know that. I know that what you're doing is you're putting all of your effort and you're working as hard as you can to create a future for yourself. And you should. So what would it be like if you could generate enough income for yourself without touching principal, so you could leave something to your heirs, not have to work, and just generate income in the future when you retire? Let's take a look at a quick example here. So let's just say you wanted a desired income of $100,000 per year. And let's say that you're age 40 and you think you're going to retire at age 67. So that gives you 27 years, and you can start to do in the back of your mind how many doubles you can get with the rule of 72, depending on the interest rate of return that you're going to get. But if we take it a little bit further and we say, how much money do you have currently saved for retirement? Let's just pick a number here because everybody's different. But let's just say it's $80,000. And the rate of return would be 9% before retirement. But after retirement, you're going to be more conservative. You're going to worry about not so much growth because you have a lot of time between now and the day that you're going to retire. So you have a little bit more room for growth. But then after you retire, you want to be more conservative and more concerned with capital preservation. So let's cut that rate of return down to 5%. Here's what would happen. You'd need $2 million at 5% to generate $100,000 a year for yourself. And your current savings would grow in that environment to about $800,000. So you need to make up the difference. And you need to make up about $1.2 million, $1.18 million between now and the time you'd like to retire. So what's the best way to do that? Save every month and save early. How much? $846 a month. Now that's going to be doable for a lot of you folks, because many of you in the mortgage industry are doing so well right now that what you want to make sure you do is you're taking the success that you're having and the money you're making and putting some money away for yourself, and forget it. Don't touch it. Let's get a little.
One thing I'll mention here too, just for context, this was, this came out, I think, around September of last year, roughly. So everything's kind of based on that.
Let's get a little interesting here, because I know many of you say, well, $846 a month, I'm doing really well. I could do that, no problem. So what if we up the ante? What if we said, look, you wanted a $300,000 a year income for the rest of your life without touching the principal? Well, $300,000 a year income means you need to save $6 million. Again, your current savings would be about $819,000. So you've got to save $5 million. That seems like an awfully big amount to put away, but you know what? $3,700 per month. What does that come to? That amount comes to approximately one transaction that you can take your earnings from one transaction, put that away for yourself, and you can retire with a $300,000 a year income. If this were your age scenario and savings, of course, it's going to be different. You should go through the exercise, and that's available right on MBS Highway, where you can easily go through this. Think about the power of that. And then what I want you to think about is that $6 million that you've accumulated. Because the beauty of this is you'll never tap into that. That's something you leave to your heirs. That perpetuates. So you're not just changing your life, you're changing many people's lives down the road because you're creating generational wealth. And one of the best lessons that I learned was reading this book called The Richest Man in Babylon by George Clason. In fact, it made such an impression on me. I made all my kids read it before they were age 12. And essentially this book teaches you to pay yourself first. Treat your future as if it were an obligation of a bill. Many of us neglect ourselves. So what you need to do is you need to save, put money away for you
Pay yourself first, and that sounds like using a little bit. Sounds like
Put money in your retirement account.
put money in your retirement account, like, so at the example I give most people is like, let's say you pay off your credit card every single month. As long as you're saving, that's good. But if, let's say you have to carry a balance on your credit card and you could pay off your entire credit card versus saving 20%, making maybe the minimum payment that month, and then making paying off the next month if you have a good month, for all commission based. You're paying yourself first by saving before you spend money on anything else. You're paying your savings account. If that makes sense.
For any other bills. I used to actually buy this book when I was originating loans for all my customers. You get them pretty inexpensively. And today on Amazon, very, very cheap. You could buy it in bulk, maybe a little note in the book and give it out to all your clients at closing. It just may change a lot of people's lives for the better. Now, speaking of your customers, let's take a customer scenario, saying they want to get a $50,000 a year income. And let's say that through this scenario, they've got $60,000 saved. And again, same rates of return. Well, they'd have to save $1 million. Their savings would be about $670,000. So they need to come up with another $329,000. That means they'd have to save $214 a month. How many of you are doing refinances for people right now where you're saving them $200, $300, $400 a month? What is your customer going to do with that? Heck, if they were saving $214 a month, that comes out to $7 a day. They're going to go to Starbucks and maybe, not always, get 2 coffees for that? Or could you do something, advise them to speak to their financial advisor, to look at this opportunity and just change the way they think? Because instead of taking $214 a month, converting it to a couple of Starbucks coffees and blowing it, how about a $50,000 a year income for the rest of your life when you retire and leaving $1 million to your heirs? That's life changing. That's what a certified mortgage advisor is meant to do.
Sorry, I know you guys aren't in the office, or a couple of you guys, Ryan, you definitely aren't, but I have a speakerphone in my office, so everybody can hear all my conversations. So like literally right before this, I was on the phone, and you guys heard the conversation with that person. I was advising her on retirement accounts and everything else. You know, it didn't come up at all once on that pre-approval call. Rate, not once. No. We talked about payment, and she said that I want to qualify for something in like the $2,000, $2,500 range. By the end of the conversation, we're talking about a $900,000 purchase. A 30-minute conversation. You guys just hear that call? Or you guys anyway, but yeah, not once did rate ever come up. And Dustin listens to all my calls. How often does rate come up in my conversations? Pretty much. So you can talk about this stuff, keep the focus on that, focus on what value you can provide, like this stuff. You're not going to be fighting with rate quite so much. So let's go to the next one. And we'll do like a couple of these. That's how we'll kind of go through all this. But no. So we're going to get short on time every single week. So this is our first.
Let's talk about how the mortgage market works. Maybe a little more complicated than most people think. It isn't funny that people get into the mortgage business and how to do an application and all the compliance stuff, but really nobody understands how the mortgage market works and what an advantage this is for you if you're able to really understand it and explain it, because it affects so many different things. So we're going to cover some things here. We're going to talk about where mortgage money comes from. Doesn't come from the sky, I promise you that, okay? And most people don't know or have a clue where it comes from. Also, we're going to talk about underwriting. You ever hear somebody say, hey, we've got common sense underwriting? Well, there's no such thing, and I'll tell you why. Now, servicing and pricing exceptions, these things are important too. What about margin calls? It's something you may have heard, but let's understand it. And then hedging is a term you often hear. These are all things we're going to cover. Now, you have to remember that, just to mention once again, the logical nature of underwriting is limited because it doesn't matter if a loan makes sense. It just matters, can I sell this? And that's because each loan has risk. It's not the risk you think about. See, most people say, what's the risk on a mortgage? And the risk on a mortgage is something that they might consider to be will that client pay me back? Look, you could buy life insurance. I could buy life insurance. You know, the life insurance company is pretty sure that I'm going to die one day, but they still sell me life insurance because they understand the arithmetic. They understand how to manage that risk. It's kind of the same thing with mortgages, with defaults, with foreclosures, with delinquent payments. They get that and they can model it. So that's not the risk that they're worried about. It's the risk that they can't manage. That's interest rate risk. See, let me give you a quick example here. Let's just say that Barry wanted to lend Dan $100,000 at a rate of 3%. And let's make it simple. It's simple interest. So all we're going to do is say that at that simple interest rate of 3% on $100,000, that's $3,000 a year that Dan would pay me on that loan. Well, if I've got that loan, let's just say it's a 30-year loan, and it balloons at the end of 30 years. But let's just say next year, for whatever reason, interest rates change and they go up to 6%. So my question to you is, that loan that I'm still holding, is it still worth $100,000? I mean, think about that. $100,000 is literally a 4-inch stack of $100 bills, but I can do anything I want. But this $100,000 investment, it is tethered to a 3% rate of return. Now, we've got a 6% market. So if I wanted to sell this, if I wanted to offload this or borrow against it, or just simply value what it is as part of my net worth or my portfolio, we know it's not worth $100,000. So what we have to try and do is say, what would somebody pay for this? Well, think about it. If the interest rate environment were 6% and someone were coming in with a new investment, how much money would they have to invest in a 6% environment to get the equivalent rate of return that they get with the investment they'd be buying from me, which generates, as I mentioned, $3,000 a year? Because remember, I'm getting on my $100,000 loan, $3,000 a year because the rate's 3%.
So for this, I know this confuses a lot of people. But yeah, so just focus on the return as a dollar amount per year. It'll make it a lot easier. So if I'm getting $3,000 a year, and I had to pay $100,000 for that in a 3% environment, if I were to get, if the rates went up to 6%, I would only need a $50,000 investment. I only need half the investment because I'm getting twice the interest. So just think about the dollar. So if I put $50,000 in at 6%, I get $3,000 a year. If I put $100,000 at 3%, I get, let's say, $50,000 at 6%, I get $3,000 a year. If I put $100,000 at 3%, I get the same $3,000 a year.
So essentially, they're expecting to get 6%.
There's if I can get. So if you were to sell that bond, I would only pay $50,000 for it because I want the $3,000 rate of return.
Yeah.
So that person's holding that bond, they lost $50,000 in value. So that's where that's when we get into hedging and shorting bonds, because
So it's considered a bond now after market.
yeah. So there's treasury bills, which are less than 1 year. There's bonds that are 1 year to 10 years, and then there's notes that are 1 year to 10 year, and then 10 year or more is bond. We'll get into that. Okay. But yeah.
Got it. Thank you.
So just to.
So because of this, you probably can do the math in your head, but in a 6% environment, all you'd have to invest is $50,000 to get a $3,000 a year return, because you're getting 6% on $50,000. Now just think about that. That means that I would lose almost half of the value if I sold it. Now, let's say Dan's a great client. Dan pays early. He's never late. He's got all the great statistics. Let's just say I put it on real estate and the LTV is super low, his ratios are high, his credit's perfect, and he pays me early. And I still lost almost half my money. Now that's something to consider. So how do we offload this risk? What do we do to protect ourselves from interest rate risk? Now that's important for me, but imagine a mortgage lender with billions of dollars in loans. They can't afford to lose that. So here we go, where we introduce to you the mortgage cycle. This is really where mortgage money comes from. And it's very important for us to understand this, because when we take a look at a mortgage, and let's just say the borrower is going to pay 3.5% as their interest rate. Now they go to an originator for that mortgage. But then what's going to happen is that the originator is going to put that loan through a mortgage company or a bank that's going to fund that transaction. So that's the first step in the mortgage cycle. And then what they're gonna say is, hey, look, we're gonna do this loan, but we know that there's risk here and it's a hot potato. So we're gonna pass that along. Now, a mortgage needs things to be serviced on it, meaning someone's got to collect the payments. Someone's got to send you a nasty note if you're late. Someone's going to tell you what your balance is or answer your questions. And that's the mortgage servicer. Now they're going to get a fee for this, just like the originator got a fee. The servicer gets a fee. And that servicer does not want to hold this hot potato. They want to get rid of it, but that's who the payments are made to. And this is where everybody gets it wrong. Everybody thinks, oh, they're holding my mortgage. No, 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 no. They don't want that hot potato. They've got rid of that. What they're holding is the servicer. You know what the servicer's like? The servicer's like an apartment building that's got a superintendent. Now that superintendent does not own the building, but they'll manage it. They'll knock on your door if they're late. They'll answer your questions. They're there to manage, to service. And the servicer does just that. They service the mortgage. So they want to get rid of this hot potato too. So what do they go to? Well, in many cases, about 70% of them, they're going to go to the largest aggregators out there. But before they do, they're going to make money for servicing. They're going to collect money, typically about 30 basis points per year on the transaction. 30 basis points, that's less than 1%. That's 0.3%. Now, oftentimes, what they'd have to do if they wanted to acquire servicing, they have to pay about a point to get that. So they're going to pay 1%. They're going to get about 30 basis points a year. So as you can imagine, it takes about 3 years to break even from that initial investment. And even if they originated the loan themselves and decided to keep the servicing, well, they're deciding to keep it instead of selling it and getting that point up front. So the break-even period is about 3 years or so on servicing. As I mentioned, they're going to get rid of this and they're going to offload this to the largest aggregators out there, Fannie and Freddie.
Just to apply this to us. Our subservicer, the people that collect our payments for us, is the money source. So that Summit Funding, ours is the money source. When we do a loan and we continue to servicing it or continue to service it, we don't pay that 1% fee. And if you know anything about our servicing portfolio pre-COVID to now, it ballooned to like 3 or 4 times what it was. And the reason for that is nobody was buying servicing. Why would you service a loan in a decreasing interest rate environment when why would you pay 1% when you know somebody's going to refinance 6 months from now, a year from now? On top of that, if somebody doesn't make their payment to the servicers required to still make the payment to bondholders. So they were on the hook. So when everybody went into forbearance, the servicers took on all of that. And then they had capital market liquidity that like the government pumped in, but still it was a big risk to the servicers. But the money sources are servicers.
Money source, and then
They're part of the
the
FHFA.
reason they're required to make the payments because then there would be a market because
That's where we buy the bond.
yeah, because they don't buy it, so they have to pay it. They guarantee it.
Exactly. It's part of the.
And when we take a look at Fannie and Freddie, it varies at times, but probably 2/3 of all loans are going to go to them. And what they're going to do is they're going to aggregate these. That gives them a big advantage. By aggregating mortgages, Fannie and Freddie now can use economies of scale and create bundles to which they're smart. They're not going to hold this hot potato. They want to offload this too. So they want to collect a fee for aggregating this, make some money, and then pass this along. But the benefit that they have in aggregating this into large bundles is that they can combat. You see, what's moving in the background are interest rates. And what they're able to do is they're able to have 30 days or 60 days that they can now take this and offload them. That's why your lock periods are 30 to 60 days. Not because that's how long it takes a processor to do a loan. You see, it's because we want to see a limitation on interest rate movement in the marketplace. And the larger the bundle that you can accumulate in that period of time, the easier it is when you go to Wall Street. And Wall Street's also going to take a fee. And what they're going to do is they're going to underwrite these. They're going to securitize them, turn them into a security, mortgage-backed securities. And then they're going to sell them. Now, you remember there's a lot of risk. So who in their right mind is going to take on the risk of this? It could go up, it could go down, you could lose money, you could make money. Well, guess who? You and me, all of us. If you take a look at what's in your mutual funds, your 401ks, your IRAs, retirement plans, it's got a lot of mortgage-backed securities in there. So it's ultimately the public who takes on the risk. In fact, the same person who's borrowing the money is the one that's actually lending it through their retirement plans. So that's the mortgage cycle. And by the way, underwriting does not work forward, it works backward.
Let me just address this real quick, Sammy. Can you hear me? Okay.
Yes, I can hear you.
Okay, so it's not that they can really insure their investments. The way that aggregators and even us, the way that we're going to ensure we don't lose too much money, and it does get into this, is we will hedge our bets by shorting the bond market. So if because they're not going to hold, even the aggregators are not going to hold on to this investment long term. They're only holding on to it long enough to put it into something called a special purpose entity. So you create basically kind of like an LLC that is sold to Wall Street. Wall Street will market that, and like you said, your mutual funds, your 401ks, other investment account will buy shares of that get a fixed rate of return. That's how like the bond coupons work, and we'll talk. It's going to go through that. But let's say when we lock a loan, a lot of people don't realize nothing's really being locked. We're just guaranteeing the borrower a certain interest rate. So there's a chance that interest rates could go up by the time we deliver that loan to the aggregator, to Fannie or Freddie. Now, if rates go up, let's say they went up 100 basis points, we would have to literally, we would have to pay the equivalent of 100 basis points, like basically pay points to deliver that loan to what we promised the borrower. So instead, we would short the bond market by that same amount, so that if, let's say, the rates went up, we make money on the short position in the bond market. We lose money on the interest rate because we have to buy down the points, but it levels out. So if you're doing one loan and selling at the cash window, you don't have to worry that much about this type of risk. But when you're hedging, if you have a $100 million, $200 million pipeline, your company could go under. Now the problem is that, and we'll get into this too, is if your short position loses too much money in the short term, and before you can deliver those loans and make the money, and which happens if interest rates go down, because just like the bond, like the value of that bond goes down, you would have to come in because the value just lost, let's say, half. You would, and when you're shorting a bond, actually, I was going to give you guys an example of that, how that works, how shorting a bond works. I'll do that right after this one. I'll go grab a bond so you guys can see. But basically, it's worth half, and they may want you to come in with more money to make up for the difference in the loss of the value of that bond. I'll explain that in just a second. I actually have a bond that can show you how that kind of works.
So that borrower, who's also in this case the investor, when they have their investor hat on, if they're going to make the investment here, then there's certain standards that they have to know, certain LTVs, certain credit requirements. Can't just be willy-nilly. You have to disclose that to them, which means that's what Wall Street has to underwrite it to, which means that what Fannie and Freddie have to bring to Wall Street, which means that that's what the servicer has to bring, which means that's what the mortgage company or the originator who's going to approve the loan has to meet. That's why when people say, well, it's common sense, it's not common sense. It's, can we sell this? Because I can't hold on to this hot potato. So I don't care if the loan makes common sense or not. I just want to know, can I offload it? And think about some of the products that are out there, right? That are high ratio, low LTV, credit score forgiveness on them. How can you do those? And then sometimes you have a loan that seems like a better loan, but it's not sellable. That's why you can't get approval on that one. So all that matters is, can I sell it? Now, as you can imagine, if the borrower in this transaction is paying 3.5%, when that same person has their investor hat on, they can't get 3.5% because everybody's taking a piece. The originator, the mortgage company, the servicer, Fannie, Freddie, Wall Street's certainly going to take a piece. They don't work for free. So by the time that comes to the individual who's the investor probably gets somewhere around 2.5%. That's why you look at the 2.5% mortgage coupon when interest rates are around 3.5%. And that explains the mortgage cycle to you. Now, the mortgage market in 2020, due to many reasons, inspired by what happened first with COVID, and then rates coming down, was really on the brink. And it was a misunderstanding. It was a misunderstanding because people as smart as the Federal Reserve didn't understand what was going on. So let's talk about the mortgage market being on the brink. Now, yes, there was forbearance. That was certainly a big issue. People weren't working, created some problems. But remember we talked about the fact that with servicing, you make about 30 basis points, but you're paying a point for it. So it's about a 3-year break even. Well, when rates started to come down dramatically, guess what you guys were all doing? Refinancing everybody. So loans were staying on the books for 6 months, 8 months, 10 months. So servicing values, which were normally worth 1 point, started to come down because they weren't staying on the books for 3 or 4 years. They were staying on the books much shorter than that. So prepayment speeds made servicing less valuable, which really went right to the core of what many mortgage companies and banks had as their asset base. So this put a lot of duress and stress on them. But then the real one that became an acute problem was margin calls. Margin calls was the big one. So I want to take a look at that with you. And in order to explain that, let's first start with how a rate lock works, because this is something you use every day. You're locking loans in, and what's really interesting is that none of your competitors really understand the mechanism here. So let's talk about it. So first of all, if you lock a customer, it's not like some big master lock comes in and surrounds the loan. They put a lock on the loan. No, what does that mean? It's nothing more than a promise. It's just a promise that we're going to give a customer an interest rate that they desired at closing if they close within a certain time frame. Please remember that even though the customer is locked, the lender is still on the hook because the mortgage market is moving. Rates are going up and rates are going down. So by the time the closing comes, if we're going to promise that customer that rate and keep our promise, then we can either make a lot of money if rates went down or lose a lot of money if rates went up, and then we have to buy that rate back down to give it to the customer. That's a big headache. That's a big risk, especially if the market's volatile. So how do we combat that? What do we do that's going to help us minimize that risk? And it's called hedging. So let's take a look at this together. So let's say that a customer wanted an interest rate at 4% and the corresponding buy price to that was 100. Okay, so 100 means par. So that means the lender is going to give you 100% of the loan amount. So if it's a $100,000 loan, they're going to give you $100,000 a close. For $200,000, they're going to give you $200,000 a closing. They'll give you whatever the value of the loan is at closing. That's 100% of the value. But when that loan's ready to close, the market's changed. Interest rates have gone up, pricing has gotten worse. Now, on a $100,000 loan, they're only going to give you 98% of that. So you're going to get $98,000 or $196,000 on a $200,000 loan. So you're losing money. They've got to still pay the originator. They've still got their overhead and expenses, but they've got to keep that promise to the customer. So how do they manage this risky component? Because they don't want to be in this business of wondering if they're going to stay in business for a month because interest rates went up and pricing got worse, or having a bad reputation and having lawsuits. So how do they keep their promise and stay in business? Well, what they do is they hedge. And hedging simply means that in this particular case, instead of losing 200 basis points, which on a $100 million pipeline would cost them $2 million, they're going to offload that risk by now taking a look at mortgage-backed securities and seeing how can I profit when mortgage-backed securities do worse. Now, you know there's ways to do this in the stock market, don't you? It's called shorting. Look, let's say you have your favorite company, XYZ, and that stock is on the stock exchange, and you think that stock price is going to go down. If it's trading at $100 today and you say, well, I think it's going down, how can I make money from that? You do something called shorting. So what is shorting? Shorting simply means that what you're going to be doing is taking that stock that you don't own, selling it today, and then buying it back in the future for what you hope will be a cheaper price. So you're just reversing the mechanism. Instead of buying first and selling later, you're selling first and then buying later. So how can I sell something I don't have? Your broker dealer allows you to borrow the shares. So you're borrowing those shares, so you own them. You're short those shares because you don't have them, hence the name shorting, because you're short the shares. So I borrow the shares, which I own.
It's just so I can
Yeah, it does make.
illustrate that, because I guess, Rick, you have that on there, Steve?
So are they,
Let's just, it could be a bond, I mean, this could be a bond, it could be a share of the stock, but let's just say you're my broker And I think the value of that stock, in this case, Standard Oil Company, I think Standard Oil is gonna go down in price. But somebody else thinks it's gonna go up in price. So Cynthia thinks it's gonna go up in price. I think it's gonna go down. So what I'll do, I don't own that share. That's yours. I mean, you have a bunch of other people, like you're investing all these guys' money, and you know they have shares of that. I'm gonna borrow it from them to say, hey, can I borrow this from you? I'll pay you an interest rate. I'm gonna give you interest on whatever this is. It's $100. I'm gonna sell it to Cynthia for whatever the market price is, $100 right now. But I think it's gonna go down to 90. So I'm selling your share to Cynthia at $100 because I think it's gonna go down to 90. Now, it does go down to 90. I can go buy it from this share back from Cynthia or anybody else in the market and give you back your stock, your certificate, your little piece of paper there. And I just bought it for 90. So I bought it later at a cheaper price. I borrowed it from you. I didn't pay anything to get it from you. I just borrowed it and I said, hey, I'll give you money back later for it. I'm not gonna give you money back for it. I'm gonna give you this exact stock. I'm gonna give you this piece of paper later on. So I sold it to Cynthia and I said, Cynthia, can I sell that back to me for $90 next week? I sold it for 100, but I'm pretty sure I can buy it back from her for 90 bucks next week. Hey, let me borrow this piece of paper real quick. I go sell this piece of paper to Cynthia for $100. It goes down in price to 90. And I say, hey, here's a piece of paper back. I just bought it at 10 bucks.
Does shorting work both ways? You want it either to go up or down?
No, so you're long, yeah. So that's the long position. That's like,
Just a long.
Yeah.
Is that what you're trying for?
yeah. So I'm shorting, I'm borrowing somebody else's shares, selling them to somebody else, a share that I don't own. And then I'm buying it back at a lower price and giving it back for share.
No, but I'll say like if it's Cynthia on her position, is she looking to?
She's long on that side.
She also trades, but question,
Until it gets par.
what
She's long. I mean, she
what
might buy the
actual
whole-
fund does Summit short?
So, well, I'll talk to you about that later. When I get caught back. Right, it depends on the coupons, so we'll talk about the bond coupons. And the reason they call it a bond coupon, is you see this thing on, you guys can't see this, but there's a bunch of like little like numbers here.
Yeah.
And back in the day, they used to actually, I mean, you used to get like a coupon book. Like on a bond, you used to get a coupon book and then you would, let's say, pay $100 for this coupon book. That's your principal, that's the par price of the bond. You would go in every single month to the bank, you tear off your little coupon, like literally a coupon, bring it into the bank, they would give you your interest. Say, oh, here's your interest for the month. It pays 3% interest. They give you 3%, you leave, come back the next month, you get 3% until that bond matures. So at the end of whatever the maturity period is, they give you back your $100. So you literally would tear off these coupons. So when we're shorting mortgage bonds, we'll get into that. The difference between what the rates that people are paying on mortgages and the coupon that is being paid out to the investor buying them. Because when we do a loan at 5.5%, that's mortgage rate. So when we do loans at 5.5%, Fannie Freddie, they're going to package them all together, a bunch of loans at 5.5% with similar credit profile. They're going to sell that on Wall Street to a bunch of other investors that are willing to get, let's say, 4.5%, like a 4.5% rate of return. So Fannie and Freddie, they're going to get their portion, the originator gets their portion, the servicer gets 33 basis points, like we learned. So that's the difference, that 1% difference between what the investor gets and what the mortgage holders are paying, like the homeowners are paying. So all those homeowners are paying 5.5%, they bundled a bunch of them together, put it together, created a special purpose entity, LLC, and you can buy shares that are paying 4.5% for all these people paying 5.5%, and everybody in the mortgage cycle gets paid a little bit, which makes up that 1% difference. But that's the future. That's the next, literally the next module.
So really quick, how, I guess it just works like that, where as a broker, you are able to borrow these shares?
Yeah, don't give it. I'll talk to you more about it.
And I sell what I don't own,
BTCC.
but I'm obligated later on to buy them back. Now I'm gonna get charged something for the borrowing of those shares. And if it gets too far away, if I start seeing that stock price go from 100 to 110, 120, 130, eventually the broker dealer is going to say, I'm not going to let this go out of control, because theoretically you could have infinite loss. They'll then have a margin call and say, hey, you've got to now give me the stock that you're short. You've got to buy it back at that higher price. So this is where it starts to get dicey. Now, by the way, if the stock did go down in value, then you buy it back. If it went to $80, you buy it at 80. You sold it at 100 in advance. You made a nice tidy profit of $20 a share. That's how shorting works. And it's kind of similar with what secondary or capital markets do in the mortgage environment. So here's what they're going to do. they're gonna short mortgage-backed securities or an equivalent. There's things called TBAs or mortgage bonds or any equivalent that will give them a profit when mortgage rates go up or mortgage bond pricing gets worse or goes down. They want to be able to make money on that trade. So here's what they would do. They would then, in their trading account, they would sell mortgage-backed securities or their equivalent short. So they'd sell them today at the time of the lock-in at the same price that the customer thinks that they're getting, which is 100 is the buy price on that loan. That's what they do right now. And if pricing indeed gets worse at the time of closing, well, they sold it for 100, they buy it back at 98, they made 200 basis points, which for every $100 million in their pipeline, they made $2 million. Now, what do? Say, hey, let's pop the champagne corks, everything's great? No, not so fast. Why? Because you promised that customer that interest rate of 4%, which now costs you more money. So in order to do that, you take the gains you made on your trading account and you use it to cover your additional expense in closing the transaction. And essentially what happens is they offset each other. And that's simply how hedging works. That's the idea behind it. Now let's just put a different spin on it and just do it in reverse, because sometimes rates get better, right? So if rates were to get better, where rates actually moved lower, mortgage-backed security pricing went up or higher after locking in, well, what happens is that 4% with a buy price of 100, when it's time to close, now I'm going to make 102. Am I getting excited? Am I getting happy because I'm going to make myself an extra 200 basis points or on $100 million, $2 million more? Not so fast. Remember that hedging account? I had to protect myself in case rates went up and pricing got worse. I lost an equivalent amount in my hedging account. So they offset each other again, but listen, here's where it gets dicey, because you know the behaviors. If rates start to get too good, what do customers do? They threaten you, especially on refinances, to walk. I say, well, you better give me that lower rate, otherwise I'm walking. And that can become problematic. You see, when the lender is in that position, they oftentimes have to acquiesce, and because of Dodd-Frank, you can't even contribute in that. So it's all out of the lender's pocket. That pricing exception becomes very costly or very dear. So these types of situations are really uncomfortable for the lender. And what they're going to need to do is try their best to make sure that they close these transactions. Now, sometimes they have to give in a little bit and it cuts into their margins, but what if rates got a lot better and customers are threatening on walking and people are breaking locks? That gets scary. And boy, what if the Federal Reserve didn't understand what I just explained to you? And that's the truth of the matter, is that in March of 2020, the Federal Reserve did not understand this. So you know more than the Fed in March of 2020. You know more right now than they did, as smart as they are. Let's take a look at what happened. So we take a look down memory lane here. This will start in the beginning of 2020, and you can see mortgage-backed security pricing here. And the Fed started to jeopardize things. So mortgage-backed security pricing, if you look to the left, started to climb, started to go up, up, up. And they really started to take off when the stock market reached its peak and started to lose some ground. So the stock market started to drop in price. And oftentimes stocks and bonds, they compete for the same investment dollar. So as stock prices start getting worse, what happens is the money that they get from selling stocks, because they want to be out of the stock market, that'll go into the bond market and fuel bond prices higher. That's an important step, because as you can see, when that started to happen, stocks started to go down, bonds go up, 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 and then right to that peak you see there. And by the way, that little mark, that little yellow caret at the very top there, that's the first time in 2020 that MBS Highway issued an alert to lock. So you can see all those beautiful pricing gains up to there. It wasn't so for a lot of people who locked in earlier, only to see pricing get a lot better. And then they were in that uncomfortably hedged position that was causing a lot of losses. Well, locking right at the top of the market was good, but some other things started to happen. The S&P officially entered a bear market in early March. And when you look at what happened to stock prices, they dropped so much, so fast, that people were margined on many of their stock accounts. So what does that mean? That means they said, hey, look, I'm greedy in the stock market. I know I could buy $100,000 worth of stock, but I could buy stock on, let's call it a 50 LTV in terms that you understand. So in other words, I'll put up half the money, buy double the stock and borrow the other half and double my gains. Well, that's great if prices are going up and stocks are going up, but it really doubles the pain when stocks are going down. And that's what started to happen. So those people that were margin were forced to sell everything. You see, think about it this way. If there were a $100,000, I'm sorry, $100 stock, a $100 stock with 50% margin, and what if that stock dropped and it was only worth $50? Well, selling the stock doesn't create any capital for you. What people were doing is they were forced to sell other assets, including bonds, which had done well. You see, it's been said in an environment that's a really bad downslide, you don't sell what you want to sell, you sell what you can sell. And that was able to generate a lot of capital for people when they sold bonds. But what it did to the mortgage bond market and treasury markets is it caused rates to rise and prices, as you can see on the chart here, to go way, way, way down. Everything sells to raise cash. And you can see the S&P was dropping, mortgage bonds were dropping. And the Fed, seeing this on March 16th, rushed to help. They said, hey, we're from the government and we're here to help. As Ronald Reagan said, some of the most dangerous words in the vocabulary. So as the Fed came in, they did prop up prices a little bit, but then they started to fall once again. The Fed worries because they were buying, but because now with the government shutdown happening with COVID, there was so much panic in the markets that prices on mortgage-backed securities dove and interest rates were much higher. People weren't looking to refinance because rates went up. People weren't looking to purchase homes because rates went so much higher amidst all the other fears. And then the Fed came in with good intentions with the bazooka. And they started buying mortgage-backed securities hand over fist, which what they thought would do is a really good thing and lower rates. And as they continued to buy in incredible amounts, the Fed was able to not only bring mortgage-backed securities back to what the level was prior to the drop, but they drove prices higher and higher and higher. In fact, 650 basis points up by buying $40 billion a day. See, by doing this, all the loans that were hedged were now way upside down. So the trading accounts were upside down. And on those trading accounts, what was happening was the broker dealer was saying, hey, you're too upside down on this. I want you to square up your positions. Let's buy back the shares that you're short on those mortgage-backed security equivalents. And when people were faced with those bills, when mortgage companies were faced with those bills of $10 million, $20 million, $40 million, $80 million, people were worried. People were scared. Almost every leader was calling and saying, oh my gosh, what is going on here with these margin calls? And the fact of the matter is that this was just unintended consequences from what the Fed was doing. The Fed wanted to do good. They thought, hey, we'll do this at a lower rates, it'll help everybody. But what they didn't realize is that they were almost destroying the mortgage and the housing market. Good intentions. Now think about what they did. In 1 week, they bought $63 billion in more, $67 billion rather in mortgage-backed securities. The next week, $183 billion. In 2 weeks, they bought $250 billion. You know, $1 trillion, that is just an incredible amount of money. $250 billion in 2 weeks in mortgage-backed securities. That drove prices way too high. That 650 basis point swing caused all these margin calls to happen. Broker dealers wanted those lenders to pay cash in those margin calls. And the tens of millions of dollars brought lenders to the brink. And so that's when we stepped forward. And what we actually did was we got in front of the Fed. We used our contacts. We used people that we know like John Walden and Lacey Hunt and Danielle DiMartino and Peter Bookbar and all our contacts that you see that we have at MBS Highway to get ourselves in front of the Fed. And then Dan Habib and I, we wrote this beautiful article that finally explained what the Fed was doing. And when members of the Fed read this, and when Steve Leisman from CNBC saw this and we explained it to him on a phone call on a Sunday night till 11:30 p.m., He could not believe it. He knew that it was time sensitive. By midnight, he already put a story out. And then the next morning when we went on and we explained what was going on, the Fed heard us. And since then, the market stabilized. This is why it's so important to understand this stuff. Don't think that your competitors know this, because they don't. They don't know how the mortgage market works. Now you do. And you could use this to your advantage to be head and shoulders as a certified mortgage advisor, smarter than your competition. And that's what this is all about. What we want to do as a certified mortgage advisor is you want to take more conversation and turn them into application. You win people over with your knowledge. You win people over by getting them to trust you. And if you can show that your expertise is far superior to someone else's, and your understanding is much deeper than a competitor's, a customer wants to take that biggest financial transaction that they're making in their life and put it in the right hands, the hands of a certified mortgage advisor.
So that's kind of 30,000 foot view of like how the mortgage market works. It's important to know how it works so that you can explain to people like why can't you just drop my rate if rates go down? Because the reason we can't, we require rates to go down 0.25%, and we charge 500 basis or 50 basis point cost, is because we're losing money on that short position. We don't want to lose the loan. We want to keep that loan just because we want obviously to get paid on that, but also to keep the relationship. But we're losing secondary, like some of the funding is losing money on that, but they also acquiesce just to make sure that we can close that loan, maintain a relationship with real estate agents and buyers and all that. But it's important to know this because it's hard for people to understand why you can't just drop the rate. Rates came down. Like Bank of America is offering me this. Why can't you just match it? Well, or we locked 3 weeks ago. We didn't expect this big change, and rates got better. But yeah, we can do it now because rates have improved 0.25%. But just because they get reduced 25 basis points, and what used to be a 1/4 point cost is now at no cost.
So locking is essentially us telling corporate to take a short position.
It's exactly what it is. And they will short the bond market based on the current pipeline. So they know if we have $100 million in loans. That's why they reached out to us. That's why they called us, or they emailed everybody saying, hey, can you just cancel your locks on loans that aren't going? Because they were still hedging based on that active pipeline. So they needed to know what is actually going to close, what can we change our short position so that we can help remove some of the excess, excess risk or the risk mitigation that we're doing. So we remove some of those puts, like those short positions in the market, and maybe give us a little bit more of a improvement of rates, like incremental, but still. So just clearing that out. But
Hey, Josh, I just have a quick question. So just because I can't hear very well, are you saying that I can hear you, but it's just not that clear?
Yeah.
Are you saying that when we are promised to them, when we so-called lock, that the company is then securing those bonds and hedging at that price where we're at par?
So no. So what happens is when nothing's getting locked, you can't lock anything like with Fannie Mae. So that our risk is transferred when we transfer those loans. We deliver to Fannie Mae. So whatever that price is at the time of delivery for us, it's like 7 to 10 days on average. So whatever the price is at that time, that's what the price is. If rates go up, we have to buy the rate down. So if it was priced at par, or what we would consider par, and it goes down to 98, it's going to cost 2 points to buy it down to whatever rate we promised the borrower. But in order to mitigate the risk of rates going up and having to buy it down, we create a short position in the bond market so that if rates go up and we have to buy it down by 200 basis points, at least that short position, we made 200 basis points. So it kind of just brings us back to level. So we don't actually make any money. This is just to kind of keep things level so you don't have these huge swings. And if some companies literally went out of business, like they went bankrupt during COVID first hit, because that 650 basis point swing, like if you had a $100 million, if you had a $100 million pipeline, let's say they were at 50% margin maintenance requirement, I mean, you're talking over $30 million It's ridiculous, or 3 million, sorry, over $3 million. If you have a billion, then, I mean, if it's just entirely possible, close a lot more loans than that. It gets a lot more expensive.
So doesn't every mortgage company have to have a certain liquidity?
Yeah, everyone, yeah, though, I mean, the liquidity requirements of, let's say it's 25 million, and you do lose like, you're paying all your, there's a lot of overhead that goes into doing loans, there's a lot of costs involved in doing loans, but that, you have a question?
Hey, Josh, I got a question for you too. And sorry, I came from a different career field, so this might be stupid, but is that why I've got some people right now, there is no par rate, where it's like, they gotta,
That's a little bit different, so they're at the higher rates, we'll get into that, because we will ease into that, because there's a lot more that goes.
Okay.
But there's a lot more, in the bond market, there's different payment coupons, so some people that are searching for a certain yield, so some people might be okay with 5%, or up 6%, 3%. But the higher you go, the less people are searching for that yield, because there's other risks involved. So they may think rates are going to come down. They don't think it's going to stay this elevated for that long. So there's not that many people willing to risk buying those bonds and having them lose value.
okay,
So
I see where you're going, okay.
So that's hard because we can only sell that interest rate.
because there's only certain liquidity. There's only like Fannie Mae and Freddie Mac, like all the investors are only buying a certain interest rate.
Oh, that's
There's
why they're
less
making you
buyers.
pay interest up front.
Yeah. So if you're selling the car,
And
and
since
you-
we're selling at that rate, we're gonna lose money, so we have to charge.
exactly. So in order to bring it down, like to the lower price. So if you have a car and there's 10 people trying to buy my car, I'm gonna be able to sell for more
Yeah.
than if there's one person.
The down payment assistance.
So I got a
Sammy,
question as well. So you know how we have like different pricing, obviously, for like a 14-day lock, 21-day, 30-day, 60-day. Is that because
Yeah.
there's going to be over that period of time, like smaller amount of loan premiums charged to us for having a shorter term short, and that's why they're able to get better pricing?
yes. So the shorter are like
Lock
the
period.
shorter the lock
Or
period.
our risk period
Yeah.
to be able to sell it? Okay.
Just like, and I can, if somebody said, will rates go down? Can you give me 100% guarantee that rates will go down? I'll say yes. I give you 100% guarantee that rates will go down.
Sometime.
When? I don't know. At some point in the future. If I
Sometime.
spend it long enough, I'll be dead. But you just have to wait it out long enough. But I want to make sure, Sammy, was your question answered? So you're really,
It was a twofold, because you also mentioned something about, I guess, they're really wanting us to know, or us to give them information if we're moving out of the month, and is that why?
no. So that's a little bit different. That's just really more of how much revenue do we have coming in this month? And that's more for projections, like for future,
Got you.
not as much the.
Okay, then yeah, you answered everything for me. Thank you.
Yeah, I thought that's cool. That was really cool.
Yeah, and then it gets, I don't know, you kind of get addicted to this as you kind of get through. But so if anybody has any other questions or little questions, kind of start batching them together, and then we'll do just a quick answer like the next time. We're going to do this every single week, so maybe I'll allocate an extra 15 minutes ahead of time to answer some of the questions for me.
And can you send us the recording? I kind of like to rewatch it.
Oh yeah, absolutely.
Okay, great.
I'll have Nicole send that out to everybody.
Thank you.
Thanks, guys. I'm gonna
Great presentation. Thank you, Josh.
This is awesome, thank
Thank
you.
you, Josh. Appreciate it.
Thanks, guys.
Hey, guys. Okay. That was horrible. So,
Yeah.
Bye-bye.
Ask you a question, Josh, on this, or do you got to go?
I'm gonna have to go, but